When lenders loan on commercial real estate, they're usually trying to be pretty conservative. In most cases, they're going to require at least a 20% down payment. They want to see a loan to value that's no more than 80%. In other words, the loan amount is 80% of the appraised value of the property. So if you have $1 million property and a lender was willing to lend up to an 80% LTV, loan to value, that would mean that the lender would be willing to lend $800,000 secured by that property. The balance of the $200,000 that may be required to purchase that property has to come from some other source. And ideally it comes from the person that's buying the property or the business that's buying the property. So lenders try to be conservative in that way by having their loan amount only be a percentage of the value of the property. Because if their borrower fails to make the payments, then they foreclose on the property. No big deal. Using the example that I just went through, we had a $800,000 loan but $1 million property. Borrower fails to make the payments to the bank forecloses. Bank sells at foreclosure, they get $1 million from the foreclosure sale. They keep $800,000. The remaining funds will go to other creditors that are secured by the property, and whatever is left over, if anything, will go to the borrower. That actually does happen. I don't know if it happens a lot these days, but it used to happen anyways. And I remember that was actually one of my first legal matters that I handled when I got into law practice, was handling excess proceeds from a trustee's sale and making sure that they got dispersed in the appropriate way. It's not common that it happens these days because over the last few years we had just a plummet in real estate values. And so, to use the example that I've been describing, you have a lender who's valuing the property at $1 million and they decide, okay, we'll loan $800,000, 80% LTV. A year goes by, 2 years go by, borrower encounters some problems, stops making the payments, lender decides it's time to foreclose. They foreclose, they do a non-judicial foreclosure, a trustee sale, and they sell it for the most money they can get for it at this trustee sale, and it's $350,000. And this scenario played out many, many, many times, exactly like that. Enormous losses in the value of the property. So you've got a bank who 2 years earlier had valued a property at $1 million, who has now just sold it at a trustee sale, and all they have to show for it is $350,000. They are short $450,000 on their loan. So they've taken their action against the property and didn't even pay them back for half of the amount of their loan. What does the bank do in that situation? This is a reality that has played out thousands and thousands of times in this market over the last several years. And the bank has some really important decisions to make at this point in time. And frankly, it's been kind of mind-boggling to me to see how unmanaged the process generally is by the banks. And unmanaged in such a way that it really ends up hurting the bank. Because unless the property meets certain characteristics of a residential dwelling under a statute that Arizona has, commonly referred to as the anti-deficiency statute, unless the property fits within those parameters, usually the lender has an opportunity to pursue their borrower for the deficiency. The deficiency is the difference between the outstanding balance of the loan and the amount that was realized from the sale in foreclosure of the collateral property. But the bank has a limited amount of time that it can pursue that remedy. And if it's not really keeping a close eye on things, the deadline passes by and they have missed an opportunity to recover at least a portion of their loss. There are several different reasons why banks don't do a very good job of managing that process. The first reason is usually, if we're talking about big institutional lenders, the process is not being managed from Arizona. It's being managed from wherever the bank is headquartered. North Carolina in the case of Bank of America. And so you have somebody in North Carolina who's not familiar with the ins and outs of Arizona real estate law and financing and may not be aware of the impending deadline that's going to prevent them from filing a deficiency action to recover the rest of their loan. And I've seen many times where the deadline has come and gone and the bank only files their deficiency lawsuit against their borrower too late. And I always feel like a hero in those circumstances because I'll have a borrower call me that's just freaked out. Oh my goodness, I'm being sued for $450,000. How am I don't have that kind of money. I'll be in debt the rest of my life, etc. And I get to tell them, oh, they missed it. They missed the deadline. We've got a defense to this claim, and it's a game over type of defense. So I love it when that happens when I'm representing the borrower. On the other hand, when I'm representing the lender in that situation, I am on my toes. I'm watching that deadline because it can be a real disaster for the lender if they miss an opportunity to recover that deficiency. So that's one reason why banks don't manage that process very well. They're just not here, and they don't know what the law is, and so they don't know how to conduct themselves according to that law. Another reason why they do not manage the process very well is that even if they did know what the law was, it's hit and miss. So in the example I just described here, where I said that the borrower is looking at this $450,000 deficiency and they're freaking out and they don't think there's going to be any way they can ever pay it. Well, the borrower might be right about that. There may be no way they're ever going to be able to pay that. And the bank may not feel that it is worthwhile to pursue that claim. Even though the claim is for a very large amount of money, if the borrower ain't got no money, they can't get any recovery from that. So they don't want to throw good money after bad. They don't want to incur a lot of attorney's fees chasing after a debt that they may not be able to recover on. I think they're making a mistake, frankly, because while you may decide as a lender that it is not worthwhile to go after a particular borrower, you should actually make that decision for the particular borrower. The decision shouldn't just be made for you by your lack of managing the loan or the bad loan. You should look at every loan case by case and have things calendared so that you can recover as much as possible if you have a bad loan out there. Thank you for watching my video. If you have any questions or comments for me, please feel free to contact me. Otherwise, have a look at some of the other videos in my series.